So now that you've hopefully had a look at the introductory video and got an idea of what the group accounts are all about and why they're needed, we need to have a look at the detailed adjustments. And this video will deal with the adjustments to the profit and loss account, to the income statement, to produce a consolidated statement of profit and loss. These are perhaps the most straightforward adjustments before we get to the statement of financial position and the preparation of the consolidated balance sheet. So if these questions crop up in the exam as part of the consolidation, it's relatively easy marks, but important that you get to grip with the adjustments and get plenty of practice working through those. So have a look through this presentation. There's a couple of questions for you to work through included in it, and then afterwards I've provided some sample questions for you to get some more practice with, so have a look at those as well. Let's just remind ourselves then, we need to prepare a consolidated profit and loss account when we've got one company, the parent company, having control, and remember that's basically more than 50% of the issued shares, having control over one or more subsidiary companies. And that consolidated statement of profit and loss includes all of the income and all of the expenses of those companies, as if everything had been carried on by just one company. That means that any intercompany transactions that wouldn't appear in the accounts if everything had been done by a single company, all of those intercompany transactions need to be eliminated from the accounts. But the other important thing to remember is that we include all of the income and expenses of the subsidiary companies, even if the parent company owns less than 100% of the subsidiary company's shares. So even though we're not legally entitled to all of the profits of the subsidiary company, we still include all of those profits because we have control over them, and control is the important thing, not ownership. Now here's an example of a very simple profit and loss account situation. We've got the parent company's profit and loss account and the subsidiary company's profit and loss account as they would appear in the individual financial statements of those companies. Now, if there is no trading between those two companies, if the parent doesn't sell goods to the subsidiary or vice versa, if there are no intercompany transactions, then the profit and loss account really is as simple as just adding the two sets of figures together, and that would give us the group profit and loss account. It will rarely be that simple, but that's basically what we're doing. If there is intercompany trading between two of the companies within the group, then the position gets more complicated, and here's an example that will try and illustrate the adjustments that we need to make. Here we've got the parent company's profit and loss account and the subsidiary company's profit and loss account, but this time there is some intercompany trading. If we look at the parent company, the £10,000 in cost of sales represents the costs of goods purchased from an external supplier. But the parent company has then sold those goods to the subsidiary company for £20,000. So in the individual company accounts, that will be shown as £20,000 of revenue in the parent company, resulting in a gross profit of 10, and in the subsidiary company it will be shown as a purchase in cost of sales of 20,000. If the subsidiary then sells those goods to an external customer for 35,000, the subsidiary will be showing a gross profit of 15. So those are the individual profit and loss accounts as they would appear in the parent companies and subsidiary companies' individual financial statements. But if we don't make any adjustments and we simply add those figures together now, then we will have inflated both the revenue and cost of sales figures over what they would have been if all of the transactions had been carried on by just one company. And remember, that's what we're attempting to show. Now, if those transactions had been carried on by just one company, what would appear in the profit and loss account? We would have the original purchase from the supplier of 10,000, and we'd have the ultimate sale to the external customer of 35,000. That transaction of £20,000 between the parent and subsidiary company wouldn't be there if everything was carried on by just the one company rather than the two. So what we need to do to prepare the group profit and loss account is to eliminate that intercompany transaction. So we get rid of £20,000 from revenue, and we also get rid of the £20,000 purchase from cost of sales. If we now add the figures together, then the gross profit and the profit before tax won't change, but you'll see that the revenue figure has gone down. It was originally 55,000. It's now gone down to 35. Cost of sales, which was 30,000, has now been reduced to 10. And those are the figures that would appear in the profit and loss account if all transactions had just been carried on by one company. So that's the main adjustment we need to make to the profit and loss accounts to produce the group P&L, and that's to eliminate any intercompany transactions, normally intercompany sales and purchases. So we need to reduce the revenue figure and we need to reduce the cost of sales figure by the same amount. Now here's another example of that. We've again got the parent and the subsidiary companies' profit and loss accounts, and in this example the parent company has sold goods to the subsidiary company during the year for £30,000. So in the parent company's profit and loss account, the revenue figure will include the £30,000 sale to the subsidiary, and in the subsidiary company's profit and loss account, the cost of sales figure will include the £30,000 for the purchase from the parent company. Now just pause the video here and see if you can quickly work out what the figures in the consolidated profit and loss account will be in this particular situation. So pause the video, just have a go at working out what the adjusted profit and loss account will be. So this time we need to eliminate 30,000 from revenue and the same amount from cost of sales, and that will give us a group profit and loss account that looks like that. So we've reduced the revenue figure to just reflect sales to customers outside of the group, and the cost of sales figure now just reflects purchases from outside of the group also. Now in the previous examples, all of the goods that have been sold within the group have been ultimately sold outside of the group to an external purchaser. the adjustments get rather more complicated where some of those items are still in stock at the end of the financial period, and this is an example to explain why that is and what adjustments are required. So here we've got a simple example of a parent and a subsidiary company. The parent company buys the goods from an external supplier for 12,000, and as before it sells those goods at a profit to the subsidiary company. But this time the subsidiary hasn't sold those goods to an external customer yet. It still has them in stock at the end of the financial period, and consequently in the subsidiary company's individual profit and loss account it will be showing the £20,000 purchase from the parent company, and then it will be showing a closing stock adjustment of £20,000, which will be reflected in the balance sheet of the subsidiary as inventory. If we do what we did before and cancel out the intercompany transaction and add the remaining figures together, then we've got this situation, which doesn't make sense. We've got no revenue at all, but we've generated a gross profit of £8,000. Can you see why that is? It's because what we're left with is a debit to cost of sales for the original purchase of 12,000, but the credit to cost of sales for closing stock is an inflated figure of £20,000 because the closing stock adjustment reflects the price that the subsidiary company paid, and so we've artificially got a profit there of 8,000. What we need to do is to reduce the value of that closing stock, because we don't want to show it at the cost to the subsidiary company. Remember, we're trying to show what the situation would be if everything was carried on by just one company. What we need to do is to value that closing stock at the cost to the group of companies, the original cost to the group. And you can see in this case the original cost was the £12,000 that the parent company paid to the supplier. So we need to make a further adjustment, and that adjustment is to reduce the closing stock figure down to the original cost to the group, not the cost to the individual company, but the cost to the group. And that reduction to original cost will result in an increase to cost of sales. And please make sure that you remember that. If we're reducing the value of the closing stock, it won't reduce cost of sales, it will increase cost of sales. We've got to add £8,000 onto the cost of sales figure to get back to that original stock value of 12. If we make that additional adjustment, then the group profit and loss account will make a lot more sense. We've got purchases of 12,000. Those items are still in stock, so the closing stock adjustment will be 12,000 as well. We've eliminated that unrealized profit that's been generated as a result of those group transactions. Now, with a bit of practice, most of the adjustments to the profit and loss account are relatively straightforward, and because of that, AAT tend to complicate somewhat the unsold stock adjustment calculations. The important thing to remember, as the slide says, is that we need to reduce the value of unsold stock to reflect the cost of those items to the group of companies, not the cost to the individual group company that's purchased them from within the group. It's the cost to the group that should be used as the value of that closing stock. And as I pointed out in the previous slide, that adjustment will mean that the cost of sales figure is increased by the amount of the unrealized profit that we're eliminating. So cost of sales will be increased as a result of this adjustment. Now in the exam, the details of the adjustment required will be given to you in different ways in the questions. Sometimes you'll be told the gross profit that the company makes as a result of that intercompany sale. Sometimes a markup figure will be given, and it's really important not to confuse those two calculations, the gross profit and the markup. So here's just a quick reminder of the differences between markup and gross profit. Here we've got sales of 210, cost of sales of 140, and a gross profit of 70. The gross profit percentage, the gross margin, expresses the gross profit figure as a percentage of the sales figure, and in this case it's a third, 33 1/3%. The markup figure expresses the gross profit as a percentage of the cost figure, and in this case it's 50%. The markup will always be larger than the gross profit percentage, so the markup is the percentage added on to cost to arrive at the selling price. So if we want to calculate the cost of a particular item and we're told that the gross margin is 33 1/3%, then the cost price will be 2/3, 66.6% of the selling price, which will give us the 140. If we're told that the markup is 50%, then the selling price will be 150% of cost. And in that case, to work out the cost price, it will be the selling price times 100 over 150, which again gives us 140. So do remember those differences. Markup is the percentage added to cost to arrive at the selling price. So if it's 20% markup, then the selling price is 120% of cost. If it's a 40% markup, then the selling price is 140% of original cost. So you can work out from that what the original cost is and what the profit is as well. Gross profit margin, that's the percentage of selling price that represents the profit after deducting cost of sales. So don't confuse those two. So here's a couple of examples of the calculations you'll need to carry out if there's a stock adjustment. In this case, the group company P sells goods to a subsidiary company S during the year for £30,000. This includes a gross profit on the sale of 20%, and at the year end 30% of these goods were still in the subsidiary company's stock. So we've got to work out how much unrealized profit there is in those unsold goods. So the unrealized profit needs to be eliminated because we want to reduce the value of inventory down to the cost to the group rather than the cost to the subsidiary company. And this adjustment, remember, will increase the cost of sales figure. And to work out the amount that needs to be added, we work out the total profit that the parent company has made on the sale, which is 20% of the sales figure, because we're told this time that it's the gross profit margin. So 20% of the sales value is profit, and 30% of that is unrealized at the moment because those goods are still in stock. That gives us an adjustment of £1,800. So the value of the stock in S Limited's accounts is £1,800 more than that stock originally cost to P Limited, and we've got to reduce it down to that original cost. So the adjustments will be, as always, reducing the revenue figure in the group accounts by the total amount of the intercompany sale and reducing cost of sales by the same amount. But then we've got this further adjustment to make because of the unrealized stock profit, and that means that we've got to increase cost of sales in this case by £1,800. And if you're thinking double entry, the other half of that double entry, remember we're debiting cost of sales, we're increasing cost of sales by 1,800. The credit entry will go to the balance sheet to reduce the inventory value in the group balance sheet. And here's a second example. This time we're told not what the gross profit margin is, but what the markup is. And in this case, it's the subsidiary company, which will normally be referred to as S Limited in exam questions. The subsidiary company sells goods to the parent company for £36,000, and that was after adding a markup of 20%. That means that the £36,000 is 120% of the original cost figure. And at the year end, the parent company had sold 60% of those goods, so 40% of them are still in stock, and we've got to reduce the value of that stock down to the original purchase price that S paid. Remember, this will be added to cost of sales. And we know the selling price is equal to 120% of original cost. Original cost is therefore 30,000, and that means that the total profit is £6,000. If we wanted to work out the total profit, then we could simply multiply the selling price by 20 over 120. That would give us the profit figure. So this time 40% of that hasn't been realized. We've only sold 60% of the goods, so we've got to eliminate £2,400 of profit. This time then the entries will be, as usual, cancelling out the intercompany sale, cancelling out the intercompany purchase, but then finally reducing the cost of the closing stock by £2,400, and that will remember, be added to cost of sales, debit cost of sales, credit inventory in the balance sheet. So here's a question that I'd like to have a go at. Here we've got the parent company and the subsidiary company's profit and loss accounts, and in this question we're told that the subsidiary company has sold goods to the parent company during the year for £50,000, and that includes a markup of 25%. So that £50,000 selling price represents 125% of the original cost to the subsidiary. And at the year end, 70% of those goods have been sold, which means that 30% are still in the parent company's stock, and at the moment that stock's valued at the price the parent company paid to the subsidiary. We've got to reduce that stock value down to the price that the subsidiary originally paid to the external supplier. So pause the presentation now, see if you can work out the adjustments and see if you can produce the consolidated profit and loss account in this particular example. So just pause the presentation until you've had a go at that profit and loss account. So if we now look at the adjustments, the first thing we always have to do is reduce revenue and reduce cost of sales by the intercompany transaction. But then we've got to make a further adjustment to cost of sales to eliminate the unrealized profit that's incorporated into the stock value at the year end. And the unrealized profit, first of all, we can work out the total profit. Remember, the £50,000 selling price represents 125% of original cost. So the profit will be 25 over 125 of the 50,000. So the total profit that the subsidiaries added on to the original purchase price is £10,000. Please don't make the mistake of just multiplying the 50,000 by 25%. You won't get the right figure. So the total profit's £10,000. 30% of that hasn't been realized because the stock is still on the shelves, and so we've got to eliminate that, which is a £3,000 adjustment, and that's added to the cost of sales figure. So we've got a net adjustment to cost of sales of minus 47,000. That will then produce a group profit and loss account as shown there, showing a gross profit of 122 and a profit before tax of 73. Now those are the main profit and loss account adjustments that you're likely to come across in the exam. There could be one or two others to look out for. Firstly, dividends. It could be that the subsidiary company has paid a dividend to the parent company. That will be reflected as investment income in the parent company's profit and loss account. That needs to be eliminated. But remember, it's just cancelling out the income from the parent company. The payment of the dividend isn't shown as a deduction in the profit and loss account. Remember, dividend payments are only deducted in the balance sheet from the retained earnings figure. So watch out for dividends received by the parent company from the subsidiary. That entry simply has to be eliminated from the group profit and loss account. The other thing that might arise is interest paid on intercompany loans. If one group company lends money to another group company and charges the company interest on that loan, then in the accounts of the company making the loan, there will be a receipt of interest as investment income perhaps, and in the company that's borrowed the money, the interest paid will be included as a finance cost. And again, both the receipt and the payment of the interest need to be eliminated from the group profit and loss account. So eliminate the interest receipt and reduce the finance costs by the amount of that interest. Those are the two main items, in addition to the sales and cost of sales, that you need to look out for in the group profit and loss account. But there could be other items in the real world. There certainly will be. And just remember the main aim. Any transactions that wouldn't appear if we were dealing with one single company, if all of the transactions were carried on by just one company, we need to eliminate anything that wouldn't be there in that single company's accounts. Now here's one final important point. Remember that if we don't own the whole of the subsidiary company, if we only own 70% or 80% of the share capital, we still include the whole of that subsidiary company's profits in the group profit and loss account, even though we're not legally entitled to part of those profits. We show all of the profits arising from businesses that we have control of. Don't forget that important control word. So we include the whole of the subsidiary's profit and loss account in the group accounts. But what we then have to do at the end of the profit and loss account after the profit after tax figure is to have a separate apportionment statement showing how those profits are shared out between the group and between the minority shareholders of the subsidiary. And that's the most important thing to remember. It's a mistake that students often make when you're preparing the apportionment statement. The minority shareholders are only entitled to a share of the subsidiary company's profits, not the profits of the entire group. So it's not a percentage of the group's profit that belongs to the minority shareholders. It's only a percentage of the subsidiary company's profits that are included in the group accounts that they're entitled to. And that brings up another important point. If you need to make an adjustment to the closing stock value and the profit that you're eliminating originally appeared in the subsidiary company's accounts, then that profit that's been eliminated needs to be deducted from the subsidiary company's profit shown in its own accounts before working out the minority share. In other words, we only want to show how much of the profit that we're including in the group's accounts belong to the minority. So let's just look back at the example that we worked through before. Remember, we're reducing the revenue and cost of sales by the amount of the intercompany sales, and we're also increasing cost of sales as a result of eliminating the unrealized profit on the closing stock, and that gives us a group profit and loss account of 73,000. And there's the important thing to remember. In this case, it was the subsidiary selling goods to the parent company. So that £3,000 unrealized profit that we're eliminating was part of the £48,000 profit before tax shown in the subsidiary company's profit and loss account. Now, if we assume that in this example 20% of the subsidiary company's shares are owned by shareholders outside of the group, minority shareholders, we need to split the £73,000 group profit before tax to show how much of that belongs to the minority shareholders and how much of it belongs to the group. So the minority share will be not 20% of the 73,000. Do not make that mistake. They are not entitled to any share of the parent company's profit. The minority shareholders are only entitled to a share of the subsidiary company's profits that we've included in the group's profit and loss account that they have a shareholding in. So in this case, the subsidiary company is showing a profit of 48,000, but the £3,000 profit that we've eliminated on the unsold stock was part of that 48. So the profit that we're including in the group figure of 73,000 for the subsidiary company is only £45,000, and it's 20% of that that the minority shareholders are entitled to. The rest of the £73,000 belongs to the group. And so if it's not a company that's owned totally by the parent company, then after the profit and loss account's been completed, we need to add that extra little statement showing how the group profit is shared out between any minority shareholders and the group. And don't forget that the minority is only entitled to a share of the subsidiary company's profits included in the group figure, not a percentage of the total group figure. Please don't make that mistake. So just a quick final recap on the profit and loss account. The first thing you need to remember is that all intergroup transactions that wouldn't appear if all trading was carried on by one company need to be eliminated. That's the overriding thing. And inventory, any stock, must be reduced to the cost to the group as a whole, not the cost to the individual company if those items have been sold in between group companies. We need to reduce the stock value down to original cost. And then, as I've just mentioned on the previous example, the important thing to remember, if there are minority shareholders, they're only entitled to a share of the subsidiary company's profits included in the group accounts, not the total group profit. And so the one thing you need to look out for in the exam questions is, if there is an intercompany transaction, who has sold to who? If the parent company is selling goods to the subsidiary company, then any unrealized profit that we're eliminating arose in the parent company's accounts, and so we don't need to take account of that when we're apportioning the profit. But if the sale was from the subsidiary company to the parent company, then any profit that we're eliminating is part of that subsidiary company's profit, and that profit that's eliminated needs to be deducted from the profit shown in the subsidiary company's own P&L before we work out the minority share of the group profit. And as with everything else, you will only get it if you do plenty of practice. You need to work through plenty of profit and loss examples, ideally with minority shareholders having an interest in the company. Now, I've produced a few sample questions. There are 4 profit and loss consolidation questions that go along with these slides, so have a go at those and then have a look at the model answers to make sure that you've got a grip with the adjustments that are required.